Hi, this is James Altucher. I'm here at TheStreet.com TV, and I'm with the relatively unknown former hedge fund manager, Jim Cramer, who's also the host of his TV show Mad Money, and the author of this new book, Cramer's Mad Money. And we're going to be talking today about it. So I want to start off, actually, you talk a lot in the book about mistakes you've made,
right,
not only at your hedge fund, but mostly actually in the course of the show. It sounds like you've learned a lot during the show. And so if you were to run your hedge fund today, given all these different mistakes that you point out and the lessons you've learned from them, what would you do differently as a hedge fund manager today?
I think that I would spend a lot more time listening to what companies say, a lot less time trying to game the ungameable. I spent a lot of time, in retrospect, in the time management I had for my hedge fund, trying to figure out a same-store sales number, trying to divine from print how companies really, what CEOs are saying. I spent a gigantic amount of time trying to figure out how a company might do, or how the Fed might do, or how interest rates might be, and not nearly enough time trying to figure out what the mob was going to do. I fought the mob. So the mutual funds like this, the heck with them, I'll take the other side. This book is about not being as contrary. It's about recognizing that there are some unknowable facts and spending a lot more time on what can be generated by homework that produces better returns.
Well, it's interesting because this is the fourth year in a row now, or 2006 was the fourth year in a row that hedge funds have actually underperformed the market. So the implication with your show and with the book is that the reader, the retail investor, can outperform the market and hence outperform the hedge funds. So what homework or what edge is the book providing that hedge funds, for instance, don't have?
All right, well, first, remember, there's a lot of cautionary stuff in the book because people have been using the show wrong. I just want to point that out, though. They'll buy Gilead without doing the homework. But what I'm saying is that we don't want to make it harder than it is. Of course, it's very clear that there is it's a difficult process to pick stocks. But when you figure out what the mob wants, and then you try to figure out the best breed of the mob, I really believe you will outperform the hedge funds. The hedge funds are by nature so contrary and by nature so skeptical that they fail to see that when the mutual funds get behind a particular theme, that is a trampoline, that is a safety net, and you can pick within that and recognize what's going on. And I certainly help with the show by trying to go with the flow. Now, it's not necessarily intellectually dazzling to go with the flow, but the intellectual dazzle has produced subpar results. And what I think is more important is to recognize where the big money wants to go and then anticipate what they want to do. And I think I give you the tools to do that.
Well, okay, so some of those tools, you actually mention in one of the chapters tricks that you like to use, like, for instance, buying banks trading for less than 2.5 times book, or buying companies that their growth rate is less than double their PE ratio. So if you had to pick one, what metric or trick is the cash machine? Which one do you really just love?
And remember, a lot of that is, I talk about in the book, is I'm a little facetious saying you can do your own lightning round, but I think people don't understand how important it is. The snap judgments that I make are really based on trying to winnow out a lot of the bad ones. But I think the classic is just how identifying that best of breed and be willing to pay for it, provided that you don't pay more than twice the growth rate. Because I think a lot of people really want to buy cheap, and cheap is just a recipe for losing money. I spend an inordinate amount of time, I think, describing why people constantly make these same mistakes. They want to buy the stock that seems lower. They want to buy the stock that represents value. And the value, it's great to represent value, but most people want to have something that happens overnight. So that's not, they don't know what they want, first of all. They don't know whether they're risk averse or not. I'm asking you to think about that. And then they want value that will go up 25% within a week. And that's not the way things are done. If you want to have something that goes up 25% within a week, I can't find it for you. But if you want to find something that could go up 25% in a year, then you try to pick a classic growth stock that sells, that grows faster than the market, that sells at a discount to that. And I try to do in this book what I think has been sorely lacking in a lot of the books about the market is try to put it in a common sense framework. I mean, a lot of people they hear the mumbo jumbo of the PE and they immediately turn it off. I spoke at a class yesterday for 11th and 12th graders, and I thought that it was economics. It was the top level economics, and I did P and E and solving for M, solving for the multiple. I lost everybody, and then these are smart kids at a very exclusive high school. And I lost everybody, and it's a reminder. This is a very basic book for people who really are just trying to figure out why Coca-Cola, even though it sells at 48, is more expensive than Pepsi at 63.
Well, and you mentioned that also, that you tend to look for not only the best of the breed, best of breed stocks, but also stocks that are potentially hitting their 52-week highs, because these are the stocks that people love, they're doing well. But you also mentioned in the part of the book where you're interviewing CEOs that if it's at a 52-week high, it better continue doing well, or else the fall could be hard.
Right.
So there's a little risk there, too.
True. But I again, this is part of my philosophy that the market validates certain things. They didn't get on the new high list for nothing. And this is a trickier thing than that I make it out in the book to some degree. But when you're on the 52-week high, your expectations by nature are higher. So the fall can be greater. But that people can make judgments that, again, based on growth rate versus PE. Like, for instance, the classic ones are Whole Foods and Starbucks. These are best of breed, okay? But Whole Foods got to more than twice its growth rate, so then it became dangerous, even though it's a very well-run company. Starbucks did the same thing, and that became dangerous. What I try to say in this book is that every time I've done, every time in the show where I've decided to overlook that valuation because I'm enamored of a concept, I have had my head slammed. So don't get your head slammed.
Well, it's interesting you bring up these kind of national chains, because you also tend to like the region to national spread.
I absolutely.
And then this brings back to the chapter you have on mistakes, Dick's Sporting Goods. So you had the great story, the regional to national expansion. You recommended it in the afternoon, and then bam, the next day.
Because that was a classic example of there was no need to go ahead of the quarter. I know there's been a debate at times on the realmoney.com side of the street.com that why not wait till after the quarter? And I think this book says that maybe I have made that mistake too much. That comes back to the hedge fund game, where everybody wants to know what limit it's going to report before they report. Everybody wants to know what Domino's is going to report before they report. Dick's would have been every bit as good a story, maybe up 1 or 2 from where it was, because it was regional, national. But no, I had to go stick my neck out. And the great time to buy was after Cramer was humbled.
So, given that you mentioned these different metrics and tricks and ideas that you use, is there a chance, it's in the book, it's on the show, it could get arbed away, meaning, so many people start using these ideas that the market becomes efficient, it gets priced into the stock?
I mean, to some degree, yes, if there was really the reach that you think the book or the TV show has. I don't think so. I've learned a lot of humility from the show, and not just because of my mistakes, but it's a much-watched show within a square mile of where we are right now on thestreet.com. But
it's a big square mile, though.
It's a big square mile, but there's a lot of people who are... we just saw some mutual fund numbers. There's very little money going into mutual funds from individuals right now. And there's very little money going into individual stocks from individuals. And... If you've watched the show or read the book, you know that I'm telling you to get in. People aren't listening, so I just have to work harder.
And do you think that's a bullish metric, that there's not?
Yes, because I'm a big believer, and I talk about this a lot in the book, in supply and demand of stocks, not just the companies. But we have a tremendous demand for stocks that is pent up on the sidelines that has not happened yet.
Well, and there's an interesting statistic. I think this was the second year in a row. 2006 was the second year in a row that the supply of shares actually went down.
I know. Can you imagine what would happen if they could flush out the cash? But I was with a group of retirees recently, and they were all saying, well, I want to get in. I said, it's so great to get 5% to do nothing, risk-free. Why don't you wait until you can't get that anymore? And, there I was aiding and abetting the notion that you should stay out, but obviously, and I try to emphasize that again and again in the book, if you know your risk level, younger people can't afford to not be in. Older people can afford to not be in.
So now, given your success with the hedge fund, with the show, with the book, how do you manage your own personal money?
Let me tell you, I did ActionAlertsPlus.com, try to run a diversified portfolio out 6 to 18 months. But
that's the charitable,
right, that's my charitable trust.
What about?
But I would tell you, let me give you this thought. at times I think, and I love thestreet.com, and I'm going to be here for a long time, but there are moments when I wish that I could have run the hedge fund the way I ran the TV show. When the TV shows run, I give this some insight. We try to come up with 4 or 5 really great ideas a week, and then reiterate those great ideas over and over again. And I was always on to the next idea at the hedge fund. For instance, I have reiterated New York Stock Exchange, MasterCard, Goldman Sachs, Sears. I never did that at my hedge fund. It'd be like, okay, we just made the 2 points in Sears, on to the next. I made my hedge fund much harder than it had to be. And I did not use any of my historical analysis. Every day I came in and made it so today is the first day. That was stupid. I made my life much harder, and I couldn't do that old way that I did it anymore. I'm 51, and it was just too difficult. But the way that I talk about in this book, the way I do the show, I could have done it for years. I regret that I didn't.
So, like in your old hedge fund, you probably wouldn't have held Google.
Oh my God! I would have traded Google. Oh, in the whole run from 200 to 500, I would have traded maybe 40 times.
But now, if you were doing the hedge fund right now, what would you do that you can't recommend to your Mad Money readers, just because it's your particular trick or skill? Or
I would be. I recommended recently. I'm doing some pieces now about buying stocks into a conference. Now, I recommend the investments into the conference, both in and out, but I would have a guy at the conference, and the moment that Celgene didn't do the number, he would call me and say, listen, you got to get out of Celgene right now. I'm in the middle of a meeting. I used to have that call, and that's a call I can't replicate for my TV viewers.
Well, given that you're focused on the show and on thestreet.com, do you think that loses a little bit of the edge, the fact that you don't have the hedge fund out there?
I mean, again, I come back to, I really revert to this. I was dumber then. I was so enamored of the tape. I was so excited about the idea of capturing early on that limited my, reading Women's Wear Daily, that limited might break up. I never had any sense of what would be the case with my portfolio 3 weeks from now. I really knew the 3-hour game. See, and the 3-hour game is a good game, and I made a lot of money. But the problem with the 3-hour game is there's no longevity to it. You can only do that kind of 18-hour day, totally focused, trading in Europe, trying to beat the research. And remember, I was before Reg FD, where you were really trying to call 50 CFOs and hope to get a couple on the phone. All of those tricks and all of what I did was very labor intensive and very, I would tell you, not smart. It was by rote. It was what I did well. That game has changed because of Reg FD. But also, I think I could have home runs. I never even attempted to hit home runs in my hedge fund. I always said singles, singles, singles. I was a single hitter. If I were to go back to that game, I'd be a home run hitter. And maybe don't swing as many times, so don't be a home run strikeout guy. But try to get a home run now and then, or at least a triple. And I just never did that. I never let the market work for me.
Well, one fun question: when's the Mad Money reality show? Fund a bunch of traders, make them do lightning rounds, talk to CEOs.
I would like to do that, but you know what? It's a good run so far, and I know that they've started the show Fast Money. I think it's meant for that, but they're not stock guys. I would tell you that I think it would be far better to do it with high school kids or college kids. And I know that what happens, the reality genre, I almost did a reality show for CNBC, but it was like me at my old hedge fund. They wanted to see me berate people. They wanted to see me humiliate people who got things wrong. And that was a guy who was doing it wrong, candidly. I know that was wrong now, but I don't want to get too existential about it, but that was not the way to produce great long-term results. It was a terrific way to produce short-term results. I would love to go into a college setting and work on a rotisserie rig. And really help people by having them come in and sell me stocks before they buy them. That's what I'd like to do. That reality show I would do, but that may only be of interest. That doesn't have the friction that reality's supposed to have, but it has the added advantage of actually helping people.
Well, thanks a lot for spending the time.
Thank you.
And once again, thanks for your candor. And
thank you.
Stay tuned for part 2 of my interview with Jim Cramer coming up next. We have a lot more to talk about.